Welcome to the deep dive. You've sent over quite a stack on L&T Finance Limited LTF. We've got the Q2 FY26 results, presentations, the earnings call transcript. A lot to unpack.
Yeah, it's a comprehensive look.
And our mission today, it's pretty critical. We're not just looking at profit numbers. We really want to get under the hood and see if LTF's big strategic pivot, their tech transformation, is it actually showing up?
Right. Is it translating into measurable financial outcomes, especially in growth and, maybe more importantly, in managing risk?
Exactly. Because that's the promise, isn't it? With their Laksha 2026 goals and these AI platforms, they talk about Cyclops and Nostradamus.
The sources give us some concrete metrics on those. So the question is, are these just buzzwords or are they actually, embedded in how the company operates? Now, can we see it on the balance sheet?
Okay, let's start with the basics then. The financial scorecard for Q2 FY26 was the headline. The momentum seems strong.
It really does show solid momentum. Looking at the consolidated performance, profit after tax PAT that hit 735 crore, which is, well, steady growth, up 6% year-on-year, 5% quarter-on-quarter. So profitability is clearly ticking up.
And scale, too.
Yeah, the scale really jumps out. Consolidated book size, over 1,007,000 crore? That's a 15% jump year-on-year.
Huge. But what really highlights the pace is the new business they're writing.
The disbursements.
Exactly. Quarterly disbursements hit a record almost 18,900 crore. That's up 25% year-on-year and 8% just since the last quarter.
Wow.
And management was keen to point out this wasn't just the usual pre-festive season rush. They felt this reflected really strong underlying demand before that typical Q3 bump.
So the engine's already running hot, basically.
Pretty much.
And wasn't there a significant milestone kind of buried in those numbers? Something about the retail book?
Ah, yes. Good catch. The retail book itself crossed the euro lakh crore mark. It's now sitting at about 1,004,607 crore. That's really the core of their whole strategic shift right there.
Makes sense. And return on assets, RO.
Consolidated ROA came in at 2.41%. That's up 4 basis points quarter on quarter. So a slight improvement there too. 4 basis points. It sounds small when you think about their big target of 2.8% to 3%.
Yeah.
Is that actually decent progress for one quarter, given everything else that's going on?
Yeah, I mean, considering the scale they operate at and the fact they're boosting disbursements by 25% at the same time while trying to manage asset quality, moving the ROA up by 4 basis points, QOQ is actually quite healthy.
Okay.
It suggests that, the improved operating efficiency is starting to filter down to the bottom line. It's not just growth for growth's sake. It looks like profitable growth.
Right.
And just quickly, for anyone holding their secured debt, the balance sheet context seems solid. They reported security coverage for their secured NCDs at 1.07 times the outstanding amount. So good asset cover there.
Got it. Okay, let's shift gears to strategy, because these Q2 numbers, they're really just the outcome of this huge transformation project.
Yeah.
Let's talk Laksha 2026. How are they tracking against those pretty ambitious targets?
Well, surprisingly, they seem to be ahead of schedule, especially on the big structural piece, the retailization.
Retailization, meaning getting out of wholesale lending.
Exactly. The goal was to have over 95% of their assets be retail assets by FY26.
And
They hit 98% in Q2 FY26.
98%.
No.
Already. So they've basically done it. They've completed that shift away from whole a full year and a half early.
Seems like it, yeah.
Wow. What does hitting that milestone so far ahead imply for the rest of their plan?
Well, it significantly de-risks the whole strategy, doesn't it? It means they can now pour 100% of their focus, their capital, into optimizing this massive retail book.
Instead of managing the wind down of the old stuff.
Precisely. The focus flips entirely from, let's say, restructuring to pure optimization, and the growth numbers back this up. Their retail book KGR from FY22 up to now, 28%.
Which is higher than the Laksha goal of over 25%.
Right. So they're exceeding on growth, too.
Okay, but fast growth, 28% CAGR, that always makes you wonder about asset quality, right?
Yeah.
Especially when their goals are super tight. Gross Stage 3 GS3 below 3% and Net Stage 3 NS3 below 1%. Are they, letting quality slip to get that speed?
That's always the key question, isn't it? Especially with disbursements rocketing up 25%, the numbers show they're disciplined, but definitely pushing close to those limits.
How close?
Consolidated GS3 is currently at 3.29%. NS3 is bang on 1.00%.
So not quite under the 3% GS3 target yet.
Not yet, but honestly, given that massive acceleration in retail, just holding the line there is probably an achievement in itself. It suggests the new loans they're adding are hopefully of decent quality.
Which brings us squarely to the technology piece.
Exactly. This is where the strategy gets really interesting, I think, where you see the potential for sustainable lower risk. We need to know if that huge tech investment is giving them measurable results.
Right, because that's the key to hitting those sub 3% and sub 1% targets consistently, yeah.
Absolutely. So let's look at Project Cyclops first. That's their AI underwriting engine.
Okay.
It's fully up and running now for their high-velocity stuff. Two-wheelers, farm equipment, SME Finance. And it's not like a static thing. They're already on version 3, and the processing power is, well, it's pretty staggering.
How much power are we talking? Scale-wise.
The system capacity is now rated at over 1,400 transactions per second, TPS.
1,400 per second.
What was it at launch?
Just 100 TPS, so a massive leap in capacity. This thing is built for huge volumes, filtering risk almost instantly.
Okay, speed is one thing, but accuracy. Does it actually reduce risk? That's the million-dollar question, or I guess the crore question.
Indeed. And they give us some hard numbers on exactly that. The performance metrics on asset quality are where you see the impact.
All right, give us the key stat.
Okay, focus on the two-wheeler portfolio. Classic high-volume, quick decision segment, right? Underwritten entirely by Cyclops now. The net non-starter rate.
Hold on, define non-starter for us quickly. Is that like a loan that goes bad almost immediately?
Essentially, yes. It typically means a borrower who fails to pay the very first few EMIs, usually within the first 90 days. It's a strong indicator of either potential fraud or immediate financial stress that wasn't caught during underwriting. A high rate means bad apples are slipping through. Got it. So what happened to that rate in two-wheelers under Cyclops?
It dropped sharply from 2.36% back in December 24 down to just 0.47% by September 25.
Wait, from over 2% down to less than 0.5%?
Correct.
That's huge. That's quantifiable proof. The AI is basically eliminating, what, 4 out of every 5 potential immediate defaults in that segment?
That's one way to look at it, yeah. It represents a massive potential saving in future credit costs. It's a phenomenal improvement in portfolio quality right at the point of origination.
And it shows the tech isn't just fast, it's actually smarter at underwriting than whatever they were doing before.
Seems that way. And the success is clearly giving them confidence. They're planning to roll Cyclops out to personal loans next quarter, Q3 FY26.
And then the secured stuff.
Yep, home loans, LAP, RBF, that's scheduled for FY27.
Okay, so Cyclops is the gatekeeper, filtering up front. What about managing risk after the loan's been dispersed? That's Project Nostradamus, right?
Exactly. Nostradamus is the other side of the coin. It's their AI portfolio management tool. Think of it as the proactive shepherd to Cyclops' gatekeeper role.
How does it work?
It's designed to give early warning signals. It uses both traditional data and, importantly, alternate data signals to try and spot customers who might be heading towards trouble before they actually miss a payment.
Alternate data. What kind of stuff are we talking about there?
Typically.
Management didn't detail everything, but usually in this space it involves non-traditional indicators. Things like utility bill payment patterns, maybe mobile recharge behavior, even data gleaned from how someone interacts with a digital app during the process.
I see. So it allows them to maybe step in proactively, offer help.
That's the idea. Maybe offer flexible repayment options, counseling, whatever, rather than just waiting for the default to happen. It's currently in beta testing in the two-wheeler segment.
And the plan is for it to go live everywhere else soon.
Yeah, they expect it to be fully live across all business lines by the end of December 2025. Okay, so better filtering with Cyclops, proactive management with Nostradamus. What's the combined effect on their overall credit costs? Are we seeing that move yet?
We are. There seems to be a structural shift happening already if you look at their credit costs before they dip into any macro-prudential provisions.
Right, the underlying cost.
Exactly. That's trending down noticeably. It was 3.80% in Q4 of last fiscal year, and it dropped to 2.98% in this latest quarter, Q2 FY26.
That's a decent drop.
It is. And management is now openly talking about aiming for an eventual medium-term credit cost closer to 2%.
2%. That's ambitious for this sector.
It is ambitious.
Yeah.
But you can see how the demonstrated success of Cyclops cutting those non-starters makes that kind of target seem, well, maybe feasible down the line.
Okay, let's quickly touch on those macro provisions you mentioned. They used some in Q2 related to some residual stress, particularly from that Karnataka ordinance impact. What was that about?
Right. They utilized 150 crore of those provisions in Q2. The stress was essentially due to regulatory changes, the Karnataka ordinance being a key one, which put some restrictions on certain recovery methods, particularly in microfinance.
Ah, so it wasn't necessarily borrowers suddenly struggling more, but rather a temporary hurdle in the collection process due to regulation.
That's the gist of it, yes. It temporarily impacted collection efficiencies and led to some increased flow forwards into delinquency buckets.
Okay, and the situation now.
The good news is that segment, the rural microfinance piece, seems to have stabilized quite a bit since then. Collection efficiency in Karnataka, for example, bounced back, strongly hit 99.18% in September 25.
That's a good sign.
Definitely. And because of that stabilization, they feel the remaining reserve is adequate. There's only 125 crore left, and management specifically stated they expect no further utilization needed from Q3 onwards.
So signaling that particular macro headache is basically over.
Seems to be the message, yeah.
That feels like a critical turning point.
Okay.
Okay, let's pivot then to where the growth is actually coming from now. We've seen the scale, but what's driving it? There's the digital push and also the secured book expansion, right?
Right. It's kind of a two-pronged growth story. They're balancing these high-yield, digitally sourced, unsecured products with very deliberately expanding their secured lending.
Okay, tell me about the digital side first.
Personal loans disbursements just exploded of 114% year on year. And a huge chunk of that is being driven by partnerships with the big tech players, Amazon, Google Pay, CRID, PhonePay.
Wow. How much business are those partnerships bringing in?
Over 1,100 crore in disbursements just from those digital partners in Q2 alone.
Okay, that's high yield growth, definitely. But personal loans, especially digital ones, are traditionally seen as higher risk. How are they balancing that out?
Primarily through aggressively scaling up the secured side, particularly gold loans. Since acquiring Paul Merchants Finance, they've been rapidly expanding that business. Gold loan disbursements hit nearly 1,000 crore 983 CICR in the quarter.
And they have big plans for distribution there.
Very big. They're aiming to build out a network of over 330 dedicated gold loan branches by the end of FY26. So a serious physical presence to back the secured growth.
Makes sense. We also saw rural business finance,
Hmm.
RBF, picking up again. Is that linked to the confidence from better collections?
It seems likely. The RBF portfolio did resume growth. Disbursements were up 16% year on year. And that confidence probably comes directly from seeing those collection efficiencies improve across the board. Pan-India zero DPD hit 99.5%.
Right. If you know you can collect efficiently, you feel better about sourcing more loans, even in traditionally tougher segments.
Exactly. It allows for calibrated risk-taking.
So this mix, they're building fast digital unsecured, balanced by rapidly growing secured gold loans, and recovering RBF. This leads to their target portfolio structure, right?
Yeah.
So you mentioned aiming for 60-40?
That's right. 60% secured assets, 40% unsecured. That's their sort of first protocol mix they're driving towards.
And the strategic thinking behind 60-40.
Well, it seems twofold. First, it's about optimizing that trade-off. You get higher yields from the unsecured book to drive ROA growth, but the larger secured book provides stability and, cushions the portfolio during economic bumps.
And second.
Second, that 60-40 mix probably helps keep their overall credit cost trajectory heading towards that ambitious 2% target we talked about. More security generally means lower average risk.
Okay, so tying this all together, they hit the retail target early, the tech seems to be genuinely reducing risk, the rural book is stabilized, the growth engines are firing in a balanced way. Does management still feel confident about that final lockship profit goal, the ROA target?
Yes, they explicitly confirmed it, that 2.8% to 3% ROA target by the end of FY27. They said it remains absolutely achievable.
Okay.
And significantly, they stressed that this target is based purely on organic growth and these internal tech and efficiency initiatives. They're not baking in any assumptions about, big surprise windfalls from selling off old stressed assets or anything like that.
So it's driven from within.
That's the narrative, yes.
Right, so that brings us to the final takeaway here. LTF has successfully made that huge pivot to retail. But what's really crucial for you, the listener, to grasp is that this isn't just a story about shuffling the portfolio mix. It's fundamentally a technology story.
Yeah, they're structurally embedding this AI-driven risk management Cyclops Nostradamus across their entire high-volume retail operation.
And the numbers we've discussed, they seem to back that up. That sharp drop in non-starters driven by Cyclops, you can draw a pretty direct line from that to the downward trend we're seeing in their underlying credit costs.
Exactly. They're not just growing bigger, they seem to be building a fundamentally more resilient, lower-cost business model, potentially more resilient across economic cycles because of this tech edge.
So what does this all really mean for you watching LTF? Here's the provocative thought. Given this immediate, measurable success of Project Cyclops in slashing those early defaults in two-wheelers, and their stated aim for a medium-term credit cost around 2%, well, if this tech advantage proves sustainable,
And if they successfully roll it out across personal loans, home loans, RBF in the coming year or so.
right, what kind of durable competitive advantage does that give LTF compared to peers who might be lagging on this kind of AI integration? And maybe more compellingly, if their risk costs consistently trend lower than the market average because of this tech, how much faster could they potentially hit those ambitious growth and ROA targets than even they are projecting right now?
It's a fascinating question. It really highlights how technology can fundamentally reshape the financial performance of these lenders.
Definitely a transformation worth keeping a close eye on. It's a clear example of strategy and tech potentially driving concrete financial results.
Agreed.
Okay, thank you for diving deep with us on LTF today. We'll catch you next time.